Welcome to Finance and Foundations. Consider this scenario. You enter a supermarket and find every shelf completely bare. That signals a shortage, a serious problem. But now imagine arriving at that same supermarket with a truckload of fresh produce, only for the manager to tell you, "We have nothing to sell, and we also won't purchase what you're offering." That situation reveals something far more disturbing, a fundamental malfunction in the mechanics of commerce itself. Under normal circumstances, any business participates on both sides of the transaction. They acquire goods, and they sell goods. That basic rhythm is what keeps the economy functioning. It's the heartbeat of trade. But on this day, Friday, January 23rd, 2026, the heartbeat of America's precious metals market hasn't merely slowed, it has flatlined. This morning, a document surfaced that is arguably more alarming than any price chart we've examined this week. It's not a Federal Reserve announcement. It's not a Treasury statement. It's a standard wholesale pricing sheet from one of the nation's premier precious metals distributors, the kind of company that serves as the critical link between the United States Mint and your neighborhood coin dealer. These are the authorized conduits through which physical metal flows into the marketplace. And this pricing sheet presents an impossible contradiction. Look at the sell column, the inventory available for purchase. Every single line reads the same. Sold out. American Eagles, sold out. Canadian Maples, sold out. 100-ounce bars, sold out. That part we anticipated. We've been tracking the depletion of COMEX registered inventories, which have plummeted over 70% since 2020. We understand the structural deficit. We're aware of China's export restrictions that took full effect in January. But examine the buy column, the prices they're offering to purchase metal from sellers, and something makes no sense at all. Multiple product lines are marked. No bid, no bid. Let's decode what that actually means in practical terms. If you telephone this major wholesaler offering to sell them 1,000 ounces of silver, they will decline the transaction. They have no interest in acquiring your metal. How can this possibly be happening? Silver is now trading at record levels, approaching $90,000 per ounce. Public demand has surged dramatically. Industrial consumption from technology manufacturers and electric vehicle producers shows no signs of slowing. The Shanghai premium over COMEX continues to widen significantly. Every economic principle suggests these wholesalers should be competing aggressively for your metal. They should be bidding $97 to $98, even above spot, just to secure inventory they could immediately flip to waiting customers. So why are they refusing to buy? Why is the primary distribution network for precious metals in America declining the most sought-after commodity on the planet? The explanation isn't insufficient demand, it's insufficient capital. We are observing a liquidity catastrophe at the wholesale tier. These enterprises aren't insolvent in terms of their assets. On paper, they own substantial quantities of silver, even if accessing it has become problematic. Their insolvency is in cash. They've exhausted the liquid funds necessary to maintain daily operations. The mechanics of the middleman. To grasp this situation, you must first understand that a wholesale bullion dealer operates fundamentally as a volume-based business. Their margins are extraordinarily thin. They acquire metal, hedge their exposure, and distribute it downstream. The entire model depends on massive revolving credit facilities to keep inventory moving through the system. They borrow capital to purchase silver from the mint, then repay that debt when they sell to retail dealers. It's a continuous cycle. But as of January 23rd, those credit facilities have reached their limits. The financial institutions that provide funding to these wholesalers have ceased extending new loans. This no-bid designation represents the financial equivalent of cardiac arrest. The blood supply, the cash, has stopped reaching the vital organs of the distribution network. When a wholesaler cannot access credit, they cannot purchase your silver. It's irrelevant that hundreds of eager buyers are waiting in line. If they cannot fund the transaction simply doesn't occur. This creates a paralyzed market. Picture yourself as the owner of a local coin shop. Customers are desperately seeking silver. You contact your wholesale supplier to restock. They respond, "We have nothing available." Then a seller enters your store wanting to liquidate their holdings. You think, "Perfect. I'll buy this and sell it to my waiting list." But acquiring it requires cash. As a smaller operation, you typically rely on selling back to your wholesaler to maintain adequate cash flow. If that wholesaler is no bid, you're trapped. You cannot liquidate excess inventory when you need working capital. The entire supply chain is seizing up. This constitutes a systemic breakdown. It's precisely what occurs when commodity prices accelerate faster than the financial infrastructure supporting them can adapt. The nearly $100 price point has overwhelmed the capacity of the intermediary network. The core truth is this: the market dysfunction stems not from absent demand for silver, but from absent capital at the largest wholesalers and brokerages nationwide. This distinction is absolutely vital. Mainstream media might attempt to mischaracterize this situation. They could observe the no-bid status and declare, "Nobody wants silver anymore. The speculative bubble has burst. That interpretation would be completely false. Everyone wants silver. The mechanism to transact it has simply broken down. The bridge connecting buyer to seller has collapsed beneath them. We are witnessing the disintegration of the centralized physical market structure. For generations, the industry relied on massive aggregator companies to coordinate metal distribution. They functioned as the central hubs of commerce. But hubs require stability. They require operational credit markets. And at this moment, credit markets for precious metals exist in a state of complete dysfunction. The wholesale sector tied its fortunes to dollar-denominated operations. They constructed their entire business framework on two assumptions: that dollar liquidity would remain abundant and that silver would behave predictably. Both assumptions proved catastrophically wrong. Silver now exhibits currency-like behavior during a revaluation event, and dollar liquidity is evaporating for anyone transacting in hard assets. This no-bid condition represents the initial symptom of hyperinflationary mechanics within this particular sector. During hyperinflation, goods vanish from shelves not because production ceased, but because the pricing mechanism fails entirely. Merchants stop accepting currency because its future value becomes unpredictable. In this instance, they halt transactions because financing costs exceed any possible profit. The validation and the warning. For those monitoring these markets closely, this moment carries dual significance. First, it serves as validation, confirmation that the shortage is genuine. If silver existed in abundance, wholesalers wouldn't be exhausting their credit capacity scrambling for every available ounce. Second, it serves as a warning. Your exit liquidity has become impaired. If you assumed you could simply sell your holdings to a dealer with minimal friction, that assumption requires revision. The buyback function has been suspended. The dealer isn't answering calls. You now possess an asset of extraordinary value that has become substantially harder to convert through conventional channels. This dynamic accelerates the market toward direct peer-to-peer exchange. It pushes commerce to the street level. When the wholesaler refuses to buy your silver, your neighbor will, and they'll likely pay cash for it. That transaction occurs outside established systems. It happens off the official ledgers. It happens without any trade documentation. The institutional market is shuttering. The informal market is emerging. The destructive hedge. In the next phase of this analysis, we need to examine how the wholesalers became financially distressed in the first place. On the surface, it appears counterintuitive. Silver has surged from roughly $30 to nearly $100 per ounce. These companies deal exclusively in silver. They should be generating record profits. They should be flush with capital. So how did they become functionally insolvent? The answer lies in a financial mechanism called hedging, specifically a strategy designed to protect them that, in a parabolic price environment, becomes a mechanism of their own destruction. To the casual observer, it seems inconceivable. You see silver approaching $100 and assume anyone selling silver must be accumulating enormous wealth. You imagine they're celebrating their good fortune? They're not. They're seeking bankruptcy protection. How does a silver dealer face financial ruin when silver achieves historic highs? It sounds paradoxical. But the resolution lies in how the contemporary financial system compelled these businesses to operate. A wholesale bullion dealer is fundamentally different from an investor or a holder. They don't acquire silver because they anticipate dollar weakness. They function as logistics enterprises. Their business model is straightforward. Buy a bar at spot price plus $1, sell it at spot plus $2. Their income derives from the spread. Whether silver trades at $20 or $200 is immaterial. They simply want to maximize throughput. But a complication exists. Between the moment they purchase silver from a refiner and the moment they sell it downstream, the price could decline. If they acquire 1 million ounces at $60 and the price drops to $45, before they can sell, they've absorbed a $15 million loss. That would eliminate their entire annual profit margin. Consequently, the banks providing their operational credit mandated hedging. They required dealers to enter into what amounts to a binding agreement with the futures market. The mechanism operates as follows. It's called maintaining delta neutrality. When a wholesaler acquires 1,000 physical ounces for their inventory, they simultaneously access COMEX and sell short 1,000 ounces of paper silver. Theoretically, this creates perfect protection. If silver's price declines, their physical inventory loses value, but their short position generates equivalent profit. The effects neutralize each other. They're insulated from price risk. But what transpires when silver's price doesn't decline, when it doesn't rise moderately, when it goes vertical? When silver escalates from $30 to nearly $99, the value of physical inventory in their warehouses explodes upward. They're sitting atop a fortune. But, and this represents the critical vulnerability, their short position on COMEX simultaneously implodes. For every dollar their physical metal appreciates, their paper short loses $1. You might respond, so what? It balances out. Over time, they'd break even. In the long term, yes. But in financial markets, you don't survive to reach the long term if you run out of cash in the short term. The margin call mechanism. This leads us to the margin call. The appreciation on physical silver remains unrealized. It's merely a figure on a balance sheet. The dealer cannot access those gains until they actually complete a sale to a customer. But the loss on the paper short position is realized continuously every single trading day. COMEX doesn't wait patiently. Every evening at market close, the exchange calculates the loss and demands immediate cash settlement. This is called variation margin. As silver rocketed from $50 to $95 and beyond, wholesalers faced margin calls potentially amounting to hundreds of millions of dollars. They were required to wire cash to the exchange every morning, merely to maintain their hedge positions. Where does that cash originate? It comes from their operating capital. It comes from funds allocated for employee payroll, shipping costs, and, most critically, purchasing new inventory. They are asset wealthy, but cash impoverished. They are positioned atop mountains of valuable silver, while every dollar of liquidity gets siphoned away to the futures market. This is the liquidity trap in action. As prices climbed higher, margin demands escalated proportionally. Eventually, they depleted their bank accounts. Then they exhausted their credit lines. Finally, they struck an impenetrable wall. This explains the no-bid phenomenon completely. Why can't they purchase your silver? Because every accessible dollar they possess is being transmitted to CME Group to cover a short position that was originally designed as protection. They hedged themselves into bankruptcy. The irony is staggering. The entire American wholesale precious metals industry is being consumed by the very commodity they sell. They bound their fate to the fiat dollar. By shorting metal, they effectively wagered that the dollar would maintain stability. They assumed silver would behave like an ordinary industrial commodity. Silver refused to comply. It's behaving like a monetary asset undergoing revaluation. And when currency revaluation occurs, anyone short that currency, or short the asset measuring it, faces obliteration. These wholesalers believed they were exercising prudent risk management. In reality, they assumed the ultimate risk, being short a monetary metal during a currency crisis. This destructive hedge has severed the supply chain at its core. Consider the scale involved. We're discussing millions of ounces. If a wholesaler maintains 10 million ounces of silver inventory while simultaneously shorting 10 million ounces on COMEX, and the price increases $65, that generates a $650 million margin obligation. How many wholesalers maintain $650 million in readily available cash? None of them do. They depend on credit, and as we'll examine next, the banks have withdrawn that credit entirely. This explains the system-wide paralysis. The metal exists physically, but the financial architecture that moves it has imploded. The paper-silver market didn't merely suppress prices, it destroyed the distribution infrastructure. By compelling physical dealers to participate in paper derivatives, banks ensured that when the genuine price movement materialized, the entire supply network would fail. The frozen credit lines. If the destructive hedge inflicted the initial wound, the credit freeze represents the physician refusing treatment to the patient. We've established how wholesalers effectively undermine themselves by shorting their own holdings to hedge against price declines. We've explained how margin calls drained their cash reserves. But in contemporary finance, enterprises rarely operate solely on internal funds. They operate on credit, revolving facilities extended by major commercial banks. For decades, these credit arrangements served as the lubricant keeping precious metals markets operational. A wholesaler would borrow $50 million from a bank to purchase silver from the mint. They'd sell the silver, repay the loan, and retain the profit. Standard industry procedure. But in recent days, banks have closed the spigot. Reports indicate that major lenders to the bullion sector are not only declining new credit extensions, they are actively demanding repayment on existing lines. Why would banks cease lending to an industry experiencing unprecedented demand? The answer involves risk modeling. For an individual investor, silver approaching $100 represents a value proposition. For a bank risk officer, it represents volatility. Banks despise volatility. When any asset produces a vertical price chart, banking risk models categorize it as a bubble, as toxic exposure. Banks examine the wholesaler's inventory, now worth nearly 4 times its value from a year ago, and grow apprehensive. They worry that a price reversal could cause collateral values backing their loans to evaporate rapidly, so they increase the haircut. A haircut represents the percentage of asset value that banks discount for safety purposes. When silver traded at $25 with relative stability, banks might have lent 90% of collateral value. Now that silver approaches $100 with extreme volatility, banks might only lend 50% of value. This generates a collateral squeeze. Despite inventory being worth substantially more, dealers can borrow substantially less against it. Their purchasing capacity has been decimated by institutional fear. But a simpler mathematical reality also explains the freeze, the capital constraint. Suppose a wholesaler maintains a fixed credit ceiling of $100 million. That's their absolute limit. When silver traded at $25 per ounce, that $100 million could finance 4 million ounces of inventory. Substantial volume, sufficient to maintain supply chain flow. Today, with silver approaching $100, that same $100 million finances barely 1 million ounces. The wholesale industry's operational capacity has contracted by 75%, solely due to price appreciation. The pipeline has dramatically narrowed. Consequently, wholesalers can conduct only a fraction of their historical business volume. They can acquire only a fraction of available metal. They can serve only a fraction of their customers. And because they're already at capacity-paying COMEX margin calls, they possess zero flexibility. They're pressing against their credit ceilings every hour of every trading day. This is precisely why they're no bid. They don't lack desire for your silver. They physically cannot write the check because banking systems respond. Limit exceeded. The contagion effect. This credit freeze represents the contagion that reaches your local coin shop. Consider your neighborhood dealer, the small business on Main Street. They don't operate like hedge funds. They lack billions in capital reserves. They operate on cash flow. They purchase silver from the public in the morning and sell it upstream to major wholesalers in the afternoon, capturing modest profits. They function as pass-through entities. But on this day, the pass-through mechanism has ceased functioning. When the wholesaler goes no bid, the local dealer loses their exit strategy. They're now holding inventory with no buyers. Their cash is immobilized in physical metal. While holding metal provides excellent wealth preservation, it's terrible for paying rent, utilities, and payroll. You cannot compensate employees with silver eagles. You require dollars. If local dealers cannot convert their silver back to dollars, because wholesalers are functionally insolvent, local dealers become functionally insolvent. It's a chain reaction. We're observing the potential for significant closures nationwide. Local shops may extinguish their open signs as they navigate this liquidity crisis. This is consolidation accelerated. In every financial crisis, larger entities absorb smaller ones. The too big to fail institutions, those with deepest capital reserves and special governmental relationships, will survive. They'll capture market share from the thousands of small enterprises facing elimination. We'll emerge with a market dominated by 3 or 4 massive corporate players. Less competition, higher premiums, greater control. This isn't speculation. It's the documented history of capitalism. Crisis accelerates consolidation. A note on source verification. Before continuing, a direct message to viewers is warranted. We're observing a collapse in confidence regarding financial institutions, but there's also a proliferation of misleading content occurring across platforms. Finance and Foundations produces content through extensive research and verification. Every claim undergoes scrutiny. Every document gets analyzed. Unfortunately, copycat channels proliferate rapidly. They appropriate content without attribution. They monetize fear without performing the actual work. If you value verified information, support original source material. Share content directly from trusted sources. Report misattributed content when encountered. In periods of market chaos, trust becomes the most valuable currency of all. The industry wipeout. The destruction of the dealer network produces a secondary effect potentially more dangerous for retail participants. It destroys price discovery. In healthy markets, thousands of dealers compete for business. This competition restrains premiums, the markup above spot price. If one dealer charges excessive premiums, consumers patronize competitors. But if competitors cease operations, surviving dealers hold effective monopolies. This connects to reports of street prices significantly exceeding spot prices. Why are premiums exploding? Partially due to shortage conditions, but also because competitive pressure is vanishing and surviving dealers recognize they're among the few remaining options. They can charge whatever the market tolerates. They can widen spreads. They can pay less when purchasing and charge more when selling. The bid-ask spread, the gap between buy price and sell price, is expanding toward historic extremes. We could observe scenarios where dealers sell an ounce for $130 while offering only $85 to buy it back, a $45 spread. Why? Because they must price in volatility. They must price in the risk that their upstream wholesaler might default on them. This friction destroys silver's liquidity for average holders. It complicates trading. It complicates using silver as transactional money. And paradoxically, that's bullish for price. When assets become difficult to trade, holders grip them tighter. They safeguard them more carefully. Velocity collapses. Let me show you where this is heading. Because the math is undeniable. Gold prices have risen 76% in the past year. January 21st, 2025, gold was $26.44 per ounce. January 21st, 2026, gold closed at $4,857 per ounce. That is not a typo. 76% in 12 months. This is not speculation. This is not a bubble. This is not retail investors piling into a hot trade. This is the market pricing in something fundamental. Goldman Sachs just raised their year-end 2026 target to $5,400 per ounce. HSBC says gold could hit $5,050 in the first half of 2026. JP Morgan is projecting continued central bank demand of 60 to 75 tons per month throughout the year. These are not gold bugs. These are not conspiracy theorists on the internet. These are the largest financial institutions in the world telling you that gold is going higher, much higher. And they are telling you why. Central bank buying shows no signs of slowing. Geopolitical tensions are escalating, not declining. The dollar's share of global reserves is declining year after year. The U.S. is running $2 trillion deficits with no plan to stop. The Federal Reserve is trapped between fighting inflation and monetizing the debt. Every one of these factors pushes gold higher. And they are all happening simultaneously. This is not one catalyst. This is convergence. But here is what concerns me most. The two-tier market that is forming right now could become permanent. Physical gold in Asia trading at premiums that never close. Paper gold in the West becoming increasingly disconnected from physical reality. And at some point, the paper market breaks. Look at the inventory data. COMEX registered inventory has collapsed to 39.4 million ounces. 2 years ago, it was over 100 million. In just the first 2 trading days of 2026, the COMEX was forced to deliver over 17 million ounces of physical silver. That is not sustainable. At the current burn rate, at the current pace of delivery demands, COMEX has approximately days of inventory remaining. That is not a buffer. That is a countdown. When that inventory runs out, the exchange does not simply admit failure. They invoke force majeure clauses. They settle contracts in cash at the official exchange price. You get paid $4,800 per ounce in depreciating currency, while the street price for physical metal rockets passed $6,000, $7,000, higher. Your wealth gets confiscated through legal technicalities. The people holding actual metal capture the real value. The people holding paper get what the system decides to give them. This has happened before. It will happen again. The only question is whether you are positioned correctly when it does. So what does this mean for you? Let me be very specific. If you hold gold through ETFs or futures contracts or unallocated accounts with bullion banks, you are exposed to counterparty risk. You are trusting that the institution holding your gold can actually deliver it. You are trusting that they have not loaned it out, pledged it against other obligations, or stored it in a jurisdiction that could freeze it. Right now, the world's most prestigious gold depository is telling customers to wait 2 months for delivery. Right now, refineries are operating at maximum capacity with multi-week backlogs. Right now, the paper-to-physical ratio in London is 9.5 to 1. These are not conditions that inspire confidence. These are conditions that precede a breakdown. If you own physical gold, if you actually have metal in your possession or in allocated storage at a reputable vault, you are in a fundamentally different position. You are not relying on someone else's promise. You are not trusting a counterparty. You own an asset that cannot be printed, cannot be sanctioned, and cannot be settled in cash against your will. The central banks understand this. China understands this. Poland understands this. Brazil understands this. 142,000 millionaires relocated internationally last year, the largest wealth migration in recorded history. They understand this. The question is whether you understand it before it is too late. What we are witnessing is not a market event. It is a monetary transition. For 50 years, since Nixon closed the gold window in 1971, the global financial system has been built on paper claims. Dollars backed by nothing but faith. Treasuries backed by the ability to tax future generations. Gold contracts backed by the assumption that delivery would never actually be demanded. That system is fracturing. The fracture is visible in the delivery delays at the Bank of England. It is visible in the two-tier pricing between Shanghai and London. It is visible in the relentless central bank buying that refuses to stop even at record prices. It is visible in the capital flows, the wealth migration, the de-dollarization that accelerates month by month. The old system is not dying quickly. It is dying slowly, gradually at first, then suddenly. We are still in the gradual phase. The vaults still have some metal. The paper price still functions mostly. The delivery delays are weeks, not months. But the trend is undeniable. The direction is clear. Gold is leaving the West. Physical assets are replacing paper claims. The system that worked for 50 years is showing cracks that cannot be patched. I want you to think about something. When confidence in a leveraged system breaks, the people who move first get out whole. The people who move second get out damaged. The people who move last get nothing. This is the mathematics of every bank run in history. This is the mathematics of every monetary transition. This is the mathematics of the gold market right now. The insiders are moving. The central banks are moving. The wealthy families are moving. They are not talking about it publicly. They are not announcing their strategy. They are just acting, quietly, systematically, converting paper claims into physical reality, getting their assets out of jurisdictions that could freeze them, preparing for a world that looks very different from the one we have known. The question is not whether you should pay attention to what they are doing. The question is whether you will act on what you see. The window is not infinite. The metal that is available today will not be available tomorrow. The premiums that exist today will be higher next month. The delivery times that are measured in weeks will soon be measured in months. This is not fear-mongering. This is pattern recognition. This is mathematics. This is the signal that central banks are sending with their actions while they stay silent with their words. $400 billion of gold has left London's vaults. The Bank of England cannot deliver on time. The paper-to-physical ratio is 9.5 to 1. Refineries are operating at maximum capacity. Shanghai is trading at permanent premiums to London. Central banks are buying record amounts at record prices. Goldman Sachs just raised their target to $5,400. These are facts, documented, verifiable, undeniable. What you do with these facts is your choice. But do not pretend you did not know. Do not pretend the information was not available. Do not pretend that the signs were not there. The exodus is happening. The vaults are emptying. The paper is separating from the physical. And when the music stops, when the last chair is taken, when the delivery failures cascade through the system, the only people left standing will be those who saw the pattern and acted. The gold is leaving London. The gold is leaving the West, and it is never coming back. Subscribe now and hit the notification bell because this story is accelerating faster than anyone predicted. In the next video, I'm going to show you exactly which institutions are most exposed to this crisis, exactly which assets have preserved wealth through every monetary transition in the last 500 years, and exactly what the timeline looks like for the next phase. You need to see that information before it is too late. The exodus is real. The clock is ticking. Position yourself accordingly. I'll see you in the next one.